Hello, my name is Matt Brennan. I'm Head of Passive Portfolios here at AJ Bell, and welcome to our Q1 2018 review. I'm going to provide an update on market and economic events over the first quarter of this year and look at how these have impacted the funds. I'll also discuss our views on the market outlook and how we've positioned the funds accordingly. After a smooth year last year, the FTSE 100 has fallen by over 11% from its high on the 12th of January to below 7,000 just before the quarter end. However, this sort of move isn't unusual. It fell by more than this in both September 2015 and February 2016. The fall over the last quarter can be explained by three main factors. Firstly, we'll take a look at the currency markets. After the EU referendum vote in June 2016, the pound fell by nearly 20% against the US dollar, as the markets worried about the outlook of the UK during and after the negotiations with the EU. Since the election of Trump in November 2016, the pound has slowly regained ground against the dollar, rising 4% this quarter, and is now only 5% below the level seen just before the June vote. The FTSE 100 is an international market, with over 70% of profits generated overseas. As the pound strengthens, these foreign profits are worth less in sterling terms. The FTSE 100 received a boost when the pound fell, and we are seeing the reverse as the opposite happens. The second factor is global interest rates. After a decade of near zero interest rates, the early shoots of a return to normality are beginning to emerge. The US is the largest economy in the world, and as such is a large influence on global growth and inflation. Jerome Powell was appointed as replacement for Janet Yellen as the chair of the Fed, the US central bank, in February. Since his appointment, he has already increased interest rates once and is expected to increase them twice more this year. When expectations of higher interest rates occur, yields on gilts and other bonds increases. Gilt yields are still a long way below historical levels and would likely rise if the UK followed suit. Over the last decade, the yield on a gilt with 10 years to maturity has averaged 2.5%. At the end of the quarter, this was 1.4%, although it was as low as 0.5% in 2016. The relationship between bond yields and bond prices is inverted, so if yields rise, prices fall. For a 10-year gilt, a jump back to 2.5% would equate to a price fall of over 10%. As investors worry about this potential change in interest rates, both bonds and equity prices are affected. Higher rates makes borrowing more expensive for companies, lowering profitability, while investors become more cautious, moving into assets such as cash and gold. Last but not least, the brewing trade war between the US and China hurt equity markets in March. Trump has proposed tariffs on steel and aluminium imports into the US, but because most people don't think it will lead to an all-out trade war, the resulting falls in the market have been relatively small. The falls due to the strength of sterling and the trade wars are part and parcel of investing, and although may cause further falls in the short term, due to our long-term investment approach, we are unconcerned and believe neither factor will have a lasting effect on the markets. The change in the interest rate environment presents greater challenges. Again, in the longer term, we believe equities will be fine, as the global economy is still strong. However, the bond market in our view does appear vulnerable. For that reason, we've opted to move all the gilt positions in the funds into shorter dated gilts, with an average maturity of around 3 years. These have lower price sensitivity to interest rate moves, but still provide a risk balancer in portfolios. The dividend yield on the FTSE 100 was 4.6% at the end of the quarter, its highest level in nearly 2 years. This offers support to investors in the longer term. As the UK was the worst performing market over the quarter, all the funds outperformed the FTSE 100, but were still down, with losses ranging from just over 2% for the cautious fund to almost 5% for the adventurous fund. Although this is disappointing in the short term, the performance is within our expected ranges. By taking this global long-term approach to investing, we aim to deliver capital growth for the funds over the longer term. And by moving from longer dated gilts to shorter dated gilts, we aim to minimise any short-term losses we'd incur if global interest rates continue to rise. As ever, we would urge you to do your own research to ensure that any investment you select is appropriate to your attitude to risk, your financial circumstances and objectives. If you are unsure about any of this, please speak to a financial advisor. Thank you very much for watching.